In the personal finance slash investing world, one of the concepts that gets repeated over and over and over is dollar cost averaging. In this video, I'm going to share with you what is dollar cost averaging and most importantly, how you can apply this investment principle to your own portfolio. I'm going to share with you some practical examples and calculations as well as some tips that are going to allow you to apply this principle a lot easier. Okay, so if you think about it, there's two ways in which you can invest your money. One of them is what it's called lump sum investing, where it is when you save a whole bunch of money and then you decide to invest it all. So that is one possibility. The other possibility is dollar cost averaging. So what is dollar cost averaging? Dollar cost averaging is rather than taking all your money and just like here investing it all at once, what you do is you invest regularly a set amount. So in this case, it's $600 every single month. The beauty of dollar cost averaging is that if you invest in an index like the S&P 500, you can see the following pattern. So first, if you look at one day, there's quite a bit of volatility going on. Even if you look at a 5-day period, more volatility. 1 month, you might still see volatility. 6 months, it looks very volatile. It looks like you don't know what direction it is going, right? But if you look over the long term at periods of 10, 5, 15 years, you will see that the general trend is upward and it seems pretty consistent. So the beauty of dollar cost averaging is that it allows you to enjoy this growth over time without worrying about when is the best time to invest the money. Like, are we at the bottom of the market? Are we at the top? Where are we? This essentially eliminates the risk that you're gonna invest once only at the very high point or at the lowest point, which you might be thinking, of course I want to invest at the lowest point, but the problem is it's very difficult to know when you're there. If it was that easy, everybody would do it and obviously benefit tremendously financially. But that's not the case. But the good thing is that with dollar cost averaging, if you invest consistently, your cost is going to be consistent and you're going to benefit from both the ups and the downs. And therefore, over time, what you're going to see is that you're going to reap a higher return. So in this case, as you can see, we created a hypothetical investing scenario. So we have the dollar cost averaging strategy and we have the lump sum invest all the money at once strategy. So we have 12 different months. We have the S&P 500 index value. We have the contribution, which is how much you've invested, and the number of shares that you've bought, as well as the number of shares owned that you already had, and the total value of your portfolio at different points. So what you're gonna find is that here you're gonna invest consistently $600. Altogether, you've invested $7,200, and in this case you're going to invest the same amount of money, except you're going to invest it all in month 7. You could have also done it in other months to show different numbers, but this is just hypothetical. Altogether, what you see is that the S&P will do what the S&P 500 does, which is it goes up and down at different times, and the same thing happens here. At the end of the day, in both cases you make money. With this hypothetical situations, you see that there's a profit for this strategy and there's a profit for this strategy. Obviously, as you can see, the profit is slightly higher for the dollar cost averaging strategy. And the reason is exactly what I told you before. Because you were consistent, because you took advantage of the times when the market was down, and also you've bought consistently, you were able to reap a higher return. And most importantly, you were able to invest automatically without thinking about what the market timing is. Like, are we at the high price? Are we at the low price? And this allows you to reap a higher return with less effort. What you may also realize is that even though you could have invested at a low price all your money, to be able to know when was a good time to invest, it would have taken you a lot of effort to figure that out, if you could even figure it out. And if you did, it also had to do with a lot of luck. So even if your return was higher, here at least you have some more peace of mind. You eliminate your emotions in terms of greed and fear, and you just stay consistent and you reap the rewards over the long term. And this is something that anybody can do. So now we're almost at the end of the video, but if you take away something from this video, it should be this. For almost all the people, what makes sense is that whether you're a more passive or active investor, you have a portion of your portfolio using the automated dollar cost averaging strategy. And one of the best ways in which you can do this is to take advantage of a tax-free savings account. So that is a TFSA in Canada. In the US, there's other accounts like Roth IRAs. And this allows you to perform this with virtually having to pay no taxes and very little transaction fees depending on the broker that you're utilizing. So if you use a stockbroker like Vanguard, you'll hardly pay anything in transaction fees. And the good thing is that you can set up the automatic investments, and you can see here how to do it. And by the way, Vanguard is not the only broker that allows you to make this ETF investments automatically. There's other ones out there. This is just an example that you can follow. You set this thing up once, and then you'll be very glad over time as you see your investment account grow with hardly any effort on your part, and most importantly, being able to reap the rewards over time and also earn usually higher than the interest rate that you would get at the bank. Now you know what is dollar cost averaging and how you can effectively apply this into your own investing. If you have enjoyed this video, make sure to subscribe and turn on the notifications on. This really helps, and most importantly, it helps you so you get notified every time we release a new high quality video like this. That's going to allow you to make your investing a lot easier and more effective. I'll see you in the next one.